Section 11.4, other types of life insurance. So again, we did term life insurance last Friday, and we found out that it was the cheapest form of life insurance that you can buy. It is only for a specific period of time, like 5 years. The one that they did in the book is on 5 years, but there probably are more in real life that you can actually get. 3 years, 10 years, whatever. So I'm not sure because I don't have term life insurance, but I do know that the book only chose to do 5 years. So we're going to look at a few tables and figure out how to do the rest. But before we do that, we have to learn about what these life insurance policies are. So whole life insurance is permanent insurance. So term life insurance is only for 5 years or 3 years or whatever, but whole life insurance is for your whole entire life. It offers financial protections for your entire life. You pay a specific premium for the entire duration of the policy. When something happens to you, your beneficiary does receive the face value. It can be used as an investment. So the term life insurance policy is just a term life policy. It's nothing else. That's why it's the cheapest form that you have. This one, you can actually use it as an investment because it does tag along with it a cash value. So sometimes if, for instance, you need a loan, you can borrow against your life insurance policy for the cash value amount. If you're wondering what that is, generally they're going to give you updates a certain number of times a year, and it does say this is how much cash value that this one has accrued. So that would be how much you could borrow against that policy. It is like a loan though, and then you would pay it back. So it does have the cash value that you can borrow against, but it is kind of like a loan as well. The cash value is the amount of money you receive if you cancel your policy. So let's say, for instance, after 30 years, you want to cancel it for some reason. If you've had it for that long, I don't know why you would, but the cash value is the amount you would receive if you cancel the policy. So even if you decide to do something else, this one is kind of like a savings plan where you would get something back. For term life insurance, if you cancel the policy after 5 years, you get nothing back. Okay, so that's kind of the difference between them, and that's why this one is worth more, because they keep track of how much cash value and everything that you have. I think we talked about this. The loan value is the same as the cash value again. The amount of your premium depends on your age when you buy it, the condition of your health, and if you smoke at the time that you get the policy. Usually with these insurance plans for life insurance, they'll have a nurse come around and she'll kind of do, some things, ask you some questions and things. Sometimes you have to do some lab work and things like that, but they will ask you if you smoke. I believe your premiums are higher if you smoke because you're more apt to get cancer and then maybe die at an earlier age. So keep that in mind. One thing that I wanted to say about this one is the younger you buy the plan, the cheaper the plan is for you. So, for instance, if you first get your life insurance policy at age 26, no, we'll say 27 because you're kind of on your parents' health insurance until 26. So let's say you get life insurance for the first time at 27. Your premium is going to be way more expensive than if your parents bought you a life insurance policy when you were a baby. Okay, so for my kids do have life insurance policies that we bought when they were babies because the premiums are cheaper then. And when Aaliyah, for instance, gets out on her own, she'll pick up the policy costs and it will be cheaper for her than it would be if you just bought it at age 27. Okay, really that's the only reason we have it is because your premiums then when you get out on your own are cheaper instead of just coming out with, something brand new as a 27-year-old. Okay, so only for the premium discounts when you're older is a good plan for that one. There are two types of whole life insurance. So this whole section kind of focuses on whole life policies. There's two different types that you can get. A limited payment policy. Both of these are lifetime protection. Premium payments are made for a limited number of years. So maybe it's a paid up at age 65. You're going to pay for this up until 65, and after that, then you can kind of sit tight and the actual policy pays for your premiums for you. Okay, so you only have to pay up until you're like 65 years old. The universal life is a combination of a life insurance policy and a savings plan. Again, it covers you for your whole life. Your premium goes into an investment account that you can borrow against or withdraw your cash value. So here's an example. So both those two that I just listed were examples of whole life policies. So turn to the table on page 428. Phyllis is 25 and wants to buy a whole life policy with a face value of $125,000. So now that we're actually on the example, it's going to look very much like we did on Friday. So Phyllis is female and whole life policy, which is the second category in there. She is 25 years old. So I'm looking at $7.50. So see if you can find that in your table on page 428. They have paid up at age 65 is the first column, whole life is the second column, and again, I'm looking at her age group, 25, so it's $7.50 for every $1,000 worth of insurance that you have. What did we have to do, which was the first thing on Friday? How many units of insurance does she have? 125, because what we did was we divided by 1,000 because that's what this table is doing. It's for every $1,000 worth that you have. So you can either just cancel the 3 zeros on your own and say she has 125 units, or you can divide by 1,000, whichever you want to do is fine. Then you grab that number from the table, which again was $7.50, and you multiply, and that is her premium for a year. So $937.50. If you were to do side-by-side term life for a 25-year-old female and whole life for a 25-year-old female, this one is definitely more expensive. And that's, of course, why we're looking at it, so you can see the different options that you might have. So for a whole year, she would pay $937.50. Now, what if you wanted to break that up into monthly or semi-annually or something like that? There's a little table below, and we want to figure out how to divide it into monthly payments. Now, you would be thinking, let's just divide it by 12, but you can't because they tack on extra fees because they have to do more paperwork. So look at the table on page 428. This breaks it down specifically. So if we wanted to take this $937.50 policy, break it down into monthly, what we do is we take that percent that is monthly, which is 8.5%, and multiply. So it would make it now, instead of $937 for a year, $79.69 every month. Okay, now if we just divided by 12, I just want you to see what the difference is. It would be $78.13. So it's a little bit more, it's like $1 something more, and that's for their paperwork charge basically. So you can't just divide it by 12 or whatever they want you to do. You have to use those 3 percentages in the table. And it does say how much can she save by paying annually. Let's see, $79.69 times 12 is $956.28. If we subtract the $937.50 that we just calculated a bit ago, that's how much she would save. $18.78. So depends on you guys. Like if you were paying this one and you don't care about $20 extra, but it makes it cheaper because you can come up with $80 a month versus almost $1,000 at one time, that's what you have to decide. You decide what works best for you. If you can do this and make it work one time a year and you can come up with about $1,000, do it. You save a little bit of money. If you can't, then you have to make the other way work. So with this one, you'd be saving just under $19 if you paid it annually, which again is not a super big deal. So that's kind of what they're going to be asking you to do at some point. Not all of them. Most of them are like the little table ones that we just did. Sorry, I flipped my tablet. There we go. So you have to make sure you're in the right column. One other thing that I want to draw your attention to. It doesn't matter what kind of insurance that you're getting, you just have to make sure you're in the right column. So paid up at age 65, there's male and female columns there. Whole life, again, there's male and female columns. But when you look at universal life, male and female doesn't matter. There's only one. So also, these are for annual premiums, the first two sets of columns. The universal life is a monthly premium. Okay, so that one they don't give you an annual premium. You would be determining monthly. So for her, 25-year-old female would be paying $24 a month for $50,000 worth of life insurance. Okay, so if you take $24 a month times 12, she would be paying $288 a year. Okay, so keep that in mind. Keep track of the headings there, and they do ask you something about that in one of the problems later. I think that's it.